When we talk about risk management inside an organization, especially in banks and financial institutions, we are essentially talking about how risks are identified, controlled, and monitored so that the company can operate safely and profitably. Every business takes risks to earn returns, but without proper control, those same risks can quickly turn into losses. A well-managed organization follows what is known as the 3 lines of defense framework. Think of this as a layered protection system. The first line of defense is the business itself, the people who actually take the risk. These include loan officers, traders, and relationship managers. Since they create the risk through their daily activities, they are also responsible for managing it. For example, a credit officer must verify a borrower's income, assess repayment capacity, and follow internal guidelines before approving a loan. The second line of defense provides oversight. This includes the risk management, compliance, and legal teams. Their job is not to take risks but to monitor them. They design policies, set exposure limits, and ensure that the first line follows proper procedures. For instance, the risk team may set a rule that the bank cannot lend more than a certain amount to a single borrower or sector. By doing this, they prevent excessive concentration of risk. So while the first line acts, the second line supervises. Then comes the third line of defense, which consists of internal and external auditors. These teams operate independently from daily operations. Their role is to test whether the controls and policies are actually working as intended. They review processes, detect weaknesses, and report directly to senior management or the board. If something is wrong, like unauthorized lending or poor documentation, auditors highlight it before it becomes a serious problem. This provides the organization with an unbiased safety check. Above all these layers sits senior management, especially the CEO. Leadership plays a crucial role in setting the tone for risk culture. The CEO ensures that proper governance guidelines exist, that staff follow policies, and that strong controls are enforced throughout the organization. Without support from the top, even the best risk systems fail. But with strong leadership, employees become more disciplined and responsible in managing risks. Now, let's talk about how risks actually enter the system, particularly through credit activities. The first step is credit origination. This is where the bank identifies potential borrowers and structures loans. But if screening is weak at this stage, risky customers may enter the portfolio. Next comes credit risk assessment, where the borrower's financial health, cash flows, and collateral are evaluated. If this analysis is rushed or inaccurate, the bank may underestimate the chances of default. Finally, we have the credit approval process, where independent committees review the proposal and decide whether to approve or reject the loan. Proper approval ensures that only acceptable risks are taken. If governance is weak at any of these stages, problems quickly arise. Employees may bypass procedures, risky loans may be approved, and losses can build up silently. Over time, this can damage profitability and even threaten the survival of the organization.